And joining us now here on the program as we discuss the state of this cattle market, really want to dive in and get some thoughts as to what we are seeing currently. Chris Swift with Swift Trading Company in Nashville joining us here on the show today. Chris, always a pleasure to catch up with you, sir. I hope you're doing well.
I'm doing very well, Jesse, and the same to you, sir.
Thank you for the time. And Chris, let's just dive right in. Cattle on Feed report for March came out last Friday. I'd love just your general thoughts. It seemed like that report pretty much in line with the pre-report estimates and expectations. What is your takeaway from that Cattle on Feed report, Chris? And what should our ranchers take away from that report as well?
Well, let's look how stable the reports have been over the last 8 months. The cattle feeder has been able to keep 11.5 to 11.7 million head of cattle on feed for 8 months in a row. We've seen carcass weights increase significantly, and we've seen the packers' ability to handle those larger carcass weights without any trouble. So we all knew that 2 to 3 years ago, we were going to start declining in our cow herd, and that's what we've done. And then last year expedited it quite a bit simply because of the drought. So in that time frame, I believe we saw some of the industry, both the cattle feeding sector of the industry and the packing industry, make some changes to prepare for today. Some of those changes are the ability to carry larger carcass frames on the rails in the packing plant. And as the genetics have improved in our cattle, we've been able to increase the carcass weights, taking that conversion to more lean meat than we do to fat. So that combination between the two, if we look, we're about maybe 10 to 15,000 head less that we're killing every week now, but yet our beef production is only down 4% year over year. So we know that the carcass weight increase and the coming time of the year is fixing to improve on that as well. So I think that the industry has done a very good job of being able to circumvent the lower number of animals and replace that with bigger animals.
Well, as you look at these numbers, Chris, and we look at this market, I've had a few folks float the notion to me that in both the fat cattle market and in feeders that maybe this recent pullback on the board is maybe our gearing up to make another leg higher. What's your thoughts there? Should we still be fairly bullish in both the fat cattle and the feeder cattle trade?
Well, bullish is probably not the right word for it. What we have to do is make sure that we understand the supply issue. And the supply issue right now has only changed very small. There is an expectation for it to change dramatically when we start holding heifers back. We've not seen us hold heifers back, and I think that's where the dividing line is. And we may not cross that line anytime soon simply because we're not to a point yet where we can make that decision. Do we have the pasture conditions? Do we have the increased hay production to be able to hold back those heifers? Can we do without the revenue from those heifers? So we got a lot of questions to answer that this year probably are only still going to be asked. You may see some decisions made, but I think you'll see more questions asked. And then if we do get the hay production, if we do get improved moisture conditions, then this time next year could be when we really see the shortage of animals out there more so than any time in the next 5 or 6 months.
So, Chris, if we look at those questions, and I agree with you, I think those are all very important, valid questions here that we have to answer this year. What are some things that we could do risk management wise? Do you have any advice, any tips there that you would care to share with our ranchers as they're looking at the state of this market here as we go and get into the spring further?
Sure. In the fat cattle market, there's really not a lot. We know that a lot of vertical integration has taken place in the fat market. And although we've seen quite a bit of interest in the fat cattle market here of lately with the commodity funds, clearly the cattle market has a story with the supply issue that a lot of the other commodity markets don't have at this particular point in time. So we look at it from the aspect of where do we see the premium? Well, we see the premium in the futures market of the feeder cattle. So if we're looking for an objective to take advantage of, where do we see the highest price? And we see it in the futures market, in the feeder cattle market. So that's the ones that we want to try to approach the most. And with those large premiums that we have in there, there's several different things that can be done to help manage that risk on there. And well, without getting into any specifics on there and spoiling any of the details to it, just know that the premium alone gives a lot of leeway. And that's what we like to see in our marketings is some leeway anyway, yet we still want some confidence that the price will either be there or we will have enough revenue generated to be able to pay back all of our input costs that we put in.
Speaking of input costs, how much is this break in corn recently playing into some decisions maybe? What are your thoughts with just what we've seen with this corn market as of late?
It hasn't been that big. One, we've not seen the old crop market decline like what we have the December contract. Basis is still really, really bad in a lot of areas, cattle feeding areas where the drought was. We're going to be short corn this whole year. We're going to ration it, probably keeping that price above 6 for as long as possible, at least until we get either through the March 31st planting intention or through some actual planting, so we can see down the road if we're going to relieve some of the pressure off of the old crop right now. But input costs, really, if you look at it, the thing that's gone up the most is the price of money. Not only has the price of money gone up, but we've seen the price of the input costs go up from the cattle aspect of it. So that's what we're most concerned with, is the price of money, the continuation of, and we'll find out more tomorrow about that. But it just seems like right at this moment that the price of money, the amount of money that it's taking, required capital to sustain a business right now, those are things that we worry about.
And that is a great point, that we're just continuing to watch what is happening with the price of money and all the factors surrounding that with the banking worries and the Fed, et cetera, et cetera. Chris, before we let you go, any other thoughts, anything else you care to share or reiterate for our listeners here today?
Let's just be real careful going forward. When we see these outlandish prices that the futures markets can produce, we have to realize that the cash market has to be able to do the same thing, or that basis spread is going to converge or diverge against you. So kind of keep that in mind, that regardless of what the futures guys do, these are totally different, two totally different markets. One is controlled by the industry. The other one is controlled by everybody under the sun that can produce a commodity account and participate in it. So we try to calm that down just a little bit by looking at the basis. And when we see the extremes in the futures markets and think maybe the cash market will get there, maybe it not, that's where we look for opportunity.
Well, we appreciate the time and insight. I know folks can learn more as well online, shootingthebull.com, and they can reach out to you there and find your telephone and more information there if they have questions. Chris Swift with Swift Trading Company. Always great to catch up with you, sir. Enjoy your week, and we will talk to you again real soon.
I appreciate it, Jesse. You too, sir. Thank you, buddy.